Hey there, everybody. It's Ted, president here at Bright Lake Wealth Management. Wanted to bring you a market update today. There's a lot going on in the financial markets. Most notably right now, we're looking at the big, beautiful bill. It passed the House of Representatives and now moves to the Senate. There's a number of things going on as we evaluate that bill that are really important to understand. Firstly, the 2017 Tax Cuts and Jobs Act, the Trump tax bill, looks like it's going to be codified. Now, of course, the Senate has to delineate and go through the bill, and there's always some changes, that get made during that process. But we do expect those tax cuts to be permanent, and so that has a lot of second-order consequences in the options that we will actually have going forward for tax strategy and tax planning with your investments. And so we will be bringing you more and more updates on that topic as we get that bill fully passed through. We expect that to happen here in the next 2 to 3 weeks, depending on how long the Senate process takes. Now, there's a couple other things that are also included in the bill. Additionally, the no tax on tips promise that was made during Trump's campaign is essentially fulfilled as the bill sits today. And in addition to that, there's been a lot of discussion about whether or not the president would be able to remove taxes on Social Security. It doesn't look like we're going to get that specifically. However, there is an increase of $4,000 in the standard deduction for those that are seniors. And so we are seeing some additional tax relief in that way as well. Now, the bill does remove the incentives around electric vehicle purchases, and this is where I would like to shift the conversation a little bit, not just toward what the bill includes, but also what the bill does not have in it. Because the Tax Cuts and Jobs Act is being codified in the bill, the CBO, the Congressional Budget Office, actually estimates that this bill will cause a nearly $4 trillion budget deficit. About $3.8 trillion is what the current estimate is. This is actually in stark contrast to the emphasis really that has been placed by the Trump administration on government efficiency and cutting spending. We aren't seeing the DOGE cuts being permanent in this bill. And in fact, because again, the tax cuts are being codified, we are expecting an increase in the budget deficit overall. That doesn't mean that there are no cuts being made, but because of how large that consequence is, we are just not seeing the spending cuts. And right now, the credit markets don't like that. There's been a broad discussion, of course, about how strong we are financially speaking as a country and how that's deteriorated over time. I mentioned the credit markets. The 30-year Treasury jumped up to a 5 handle, over 5%, on this news that the bill is passing through the House. That's the market saying to DC, we don't like this. We're concerned about the financial state of the country long term. We saw the headline last week, actually, that Moody's was downgrading the U.S. from its AAA rating. This is on the heels of S&P and Fitch in the past downgrading the financial standing of the U.S. So the market wasn't so surprised by it, but these are signs that the folks in D.C. need to start listening to and actually address the spending status of the United States if we want to see, certainly those types of credit ratings come back to normal. I think a lot of this really should be centered around a discussion of how do we get back to spending levels that are more pre-COVID-esque, if we could put it that way. There's a broad debate about whether we should have a balanced budget or not. Most people, when we talk about your personal finances, think we should have a balanced budget. And trying to get to that type of place, or at least run more moderate deficits so that we can grow our way out of the problem, I think is ultra important for the long-term financial success of the country. And I do think that point we could expound upon. Of course, there's kind of two ways we can get out of this mess. We can cut spending down substantially and get to that, balanced budget or, moderate deficit, and we can also grow our way out of it as a country. And I don't really think right now there is the political will that is required to get the spending in check. Sure, Republicans have put an emphasis on this at times, but given the slim majority that they have in the House of Representatives, there's a lot of Republicans that are actually pretty soft on these spending measures. And in fact, at least in my opinion, I don't think we're going to see real austerity in Washington, D.C. unless it is a bipartisan approach. So if we set that aside for a second and we look at door number 2, we can also grow our way out of this as a country. Now, it's a more maybe rose-colored glasses view, but I do think that there's a case to be made for how we might do that. And it's centered around the long-term trend that we are seeing and that we have seen over the course of our country's history. At the end of the day, the average American's productivity has skyrocketed over our country's history. We can point back to the Industrial Revolution. We can point back to, everything that happened after the World Wars. And the internet age, right? The internet coming online and the average American worker becoming more and more productive. That growth has allowed us to exponentially explode our economy and become what we are today, which is the world's largest economy. And we see that trend again here with the developments in and around artificial intelligence. And so, as we look at how AI is going to transform our country and the way we work, and ultimately the productivity that the average American worker is able to produce, that is the optimistic path forward where we are able to grow our way out of this issue. Now, in order for that to happen, we are really looking at one key commodity here, and that specifically is energy. The other thing that this bill doesn't go far enough on, in my opinion, is an incentive around energy creation. Today, the United States in any given year can produce about 1 trillion watts of energy, and that's expected to increase to about 2 trillion watts over the next 15 years. Now, that's important because our AI race, as it's been coined, is against China. And today, China produces about 3 trillion watts of energy, expected to rise to about 8 trillion over the next 15 years. And as we've heard in the news headlines again and again and again, getting AI to a place that it can actually transform the productivity in the workplace is going to require an unbelievable amount of energy. The energy demand that we are going to have as a country over the next 5 and 10 years is going to be exponential. We already have needs. We all know, about the brownouts and the wildfires that are caused by the grid not being up to snuff as it should be. So just the growth that we are expected to have, I think hopefully will maybe be able to address that. But in order to get us to that place where we can win that AI race against China, we are going to need to see more initiatives out of DC around energy specifically. Now, of course, outside of that, there's the continuing discussion around what to expect with tariffs. Today, the financial markets actually sit higher than they were on Liberation Day, April 2nd, when those tariffs were instituted, and we saw all that volatility. So the markets are starting to get clarity about what to expect with tariffs. Obviously, there's still a lot of rhetoric going back and forth, and a lot of these trade deals still need to come to fruition. That said, the markets are starting to move forward and look ahead, and it is not having the negative consequences in terms of valuations as we were seeing, in early and mid-April. There's a whole lot of nuance as to why that is the case, but ultimately that is the result we're seeing today. In order to get a real post-mortem of all the tariff consequences, I think what we're really going to want to look at is where the earnings of our major companies here in the United States produce come the end of Q2. Obviously, people were doing a lot of purchasing ahead of the tariff announcements because they were expected. And so we've seen a lot of the Q1 earnings with no huge concerns, at least around the tariff issue. However, that really is going to come to, it'll have a lot more clarity come the end of Q2, so we have our eyes on that. If we get through the second quarter earnings season and we don't see any huge surprises, I think that for the rest of 2025, really what we are going to be looking at isn't so much the rhetoric in DC as much as it will really come down to quality earnings and economic vital signs, the things we talk about all the time, the GDP, the inflation figures, consumer sentiment, of course, interest rates and the like. And so, of course, we will continue to update you about the status of this bill going through Congress and all those economic vital signs. Thanks for tuning in. And as always, here at Bright Lake, we like to say, have hope in a bright future. Thank you.